Andrea sends in a question, says, I have a question regarding the married put approach, something I referenced earlier. All right, so the married put approach, let's just go there. Our preferred approach for the married put, we're going to buy a stock. We're going to buy an in-the-money put, 1 or 2 strikes in the money, 5 or 6, 7 months out in time to control risk to single digits. And then we're going to use 13 different income methods. 4 of the income methods revolve around using the put as your second asset. Others are direct income. Hey, just sell a call against it, do a spread inside the married put. You can actually do a bearish spread that leaves the upside open. Ratio call spreads, butterflies, condors, that's all described in our full course, The Blueprint, which walks you through the proper setup, structure, income methods, when and how to use them, and much, much more. And of course, we take just a basic look at the married put search right now, and we see positions on NVIDIA. We might use that as our example. A little bit high of a risk for 196 days, but that's okay, 8.8%. You expect that. Palantir has been on fire. That's one I considered opening. I haven't missed the boat yet, but it's a little bit high price for me right now. It's almost on par with NVIDIA. Roblox has been really strong. Robinhood, they did well with their earnings, I think, as well. Deutsche Bank, Stone Cold, Goldfields. I'm in a different one right now. Instead of Goldfields, I'm in Alamos Gold. Did that about the same time. Affirm Holdings is one Ernie's in on the Fusion portfolio at Radioactive Trading. Barrick Mining as well. So in any case, think about a married put, and a lot of times you hear the terms, hey, you're going to do a married put, you're going to buy a stock. Hey, I'm going to buy a stock at 182. I'm going to buy NVIDIA at 182. And I just want to protect the what if. So I'm going to buy a 1 month out September put at 160, and it's going to cost me $1.20. Well, the problem is the put is the insurance. And in that case, if I'm down to 160, the put insurance doesn't kick in until the stock hits 160. Also, you're buying only 20 or 30 days out in time. What's the problem with that? Well, you know, as option sellers, as we all sell options, whether it's credit spreads, whether it's simply covered calls, cash secured naked puts, when you sell week by week, you get a better annualized return, theoretically, than selling month by month. And if you sell month by month, you get a better annualized return than selling 6 months out in time. And if you do sell 6 months out in time for the higher premium, better downside protection, you get a higher annualized return than selling 1 year out in time, even though the premium is higher. Well, buying is the opposite. It's like buying insurance for your car. You know, I could pay $20 per month. Okay, no one is paying $20 a month. Let's say $200 a month to insure my car month by month. But if I do a 6-month policy, they might only charge me $1,000. And if I buy a year out in time, they might only charge me $900 instead of, I'm sorry, I meant $1,900. Instead of the $2,400 it would cost me. So you get a discount. Option buying is the same. Insuring the stock with a put is the same. I want to buy further out in time because this option that's 196 days out in time is not, well, let's call it 200 really, but it's not 7 times the cost of the 30-day out option. If I'm buying month by month, even cheap out of the money insurance, which is going to have that high risk in the double-digit range because the insurance doesn't kick in until I hit $160. Here I'm guaranteed that even in the worst case scenario, I can only lose 8.8%. And that's the worst case scenario. If I held this all the way to February expiration, made no adjustments or income methods on this trade, accepted no dividends, and the stock was trading below 185, then I'd hit the maximum loss of 8.8%. Tomorrow, if the stock moves up $2 again, as it did today, or Monday, my apologies, if it moves up $2 as it did today, my put's only going to decline by $1, $1.10. I'm going to be seeing a profit of 90 cents. The put doesn't go to zero when you buy it. It's still trading just as if you bought a 100 or 90 day out long call. It doesn't go to zero. It still has time value. It still has intrinsic value. The risk is just the time value of the put option. Okay, now, Andrea's question. That's just a refurb of the married put, just a review of the married put, just so we're all on the same page for those of you that aren't 100% aware of how we approach it. This is our approach for the married puts. Now, Andrea's question. If the underlying stock shoots up, when do you suggest to close the underlying to secure the profit? And conversely, when should you close the protective put if it's losing? Of course, it could happen opposite. The stock collapses and the put increases in price. The mechanics of the strategy is clear, but I am not sure how to act in the two situations. I imagine it's all described in the blueprint. You probably can't give away these answers for free. No, it is there, Andrea. It absolutely is, those discussions. It's in the individual income method chapters. But what we're talking about here is more of a systemic approach. It leads in great into something that I wanted to bring up today, related to a coaching session I had earlier this week on Wednesday. I think it was. Maybe it was Thursday. I think it was Thursday. My apologies. And we're in this earnings cycle right now. So let's go to my portfolio. And so, I'm sorry, this was from June 6th. This is some of the positions we had at BABA. Oh, it's down. Not doing well on that. And a Kinross Gold married put position that was opened on 528. Historically, we'd be up 20.4%. Not one of my positions I'm in. My AGI position is not doing as well. Alamos Gold position is not doing as well as that one was. But let's go ahead to, here we go, radioactive trading portfolio. Perfect. These are my actual positions right now. Oh, it's next week. I'm sorry, my 120 call for Planet Fitness will expire next week. I've got the 120 strike. Now, I want to focus on ONON Holdings for a minute. On holding, ONON is the stock symbol. Originally, I bought this stock at 59. It went up to 86 at one point, and the stock collapsed. Now it's down 13.34 from where I bought it at 45.66. Down 22.6%. It's down almost 50%. Darn near close to it, Andrea, from its high. Now, I've got a profit of 5.2% on this position because it's bulletproof. Had I closed when the stock was at 52 before it started this new decline in the last 3 weeks, I would have gotten out with about an 11% return. Why didn't I do that? Why am I still holding on to this position? Let's look at the stock chart, and you guys are going to say, what the heck are you doing with this position? I've done multiple income methods on this trade, got it to bulletproof status. As you can see here, I'm sorry, it went up to 60. It's 52, guys, 64. I'm sorry, I thought it was 82. I'm thinking of another stock. I sincerely apologize. But this went up to 64 from our purchase price at 59, dipped back down here to the 52s, sort of climbed back up. At this point here, I still was in the married put. What I did is I sold a put at about the 55 strike, and it pulled back. I got reassigned the stock at 55 after closing out, getting assigned here at 60. And moved the put. The stock went up. I rolled the put back up, and now that's where we are. I'm at this bulletproof status here, and now the stock has just been doing this. What have I should have done? When I saw the MACD break, Andrea, I should have bought an extra put on this one. When I saw that here drop below the SMA 50, that's a perfect time for income method number 12. But it started to pull back up, so I didn't think about it, and then it's just the last 10 days. I was on vacation, and then I had my sister-in-law's wedding. And so I missed some of this, but that's okay. That's fine. Because as you can see, for my initial purchase price, we're down that range of 23% or so, 22.6%. I still have a profit of 5%. You look at that chart again, and you say, Mike, why aren't you closing this position? Take the 5% and move on. Well, why I'm holding on to this position right now is because you see these little lightning bolts here. Earnings are ex-dividend within a week. Let's go to important dates. All of my other ones have had earnings, as I mentioned, the Caesars Palace one, the Kraft Heinz one, and ONON is coming on the 12th. So next week before market. So the trick is, on this position, let's just go to the profit and loss chart for where I am right now. The max risk is 3.3%. Negative 3.3%, meaning the most I can lose on this position is 3% if the stock continues to fall. I'm at that 5% return right now with earnings coming up in the next 4 days. I could take 5% now. I could have taken 11% about 12, 15 days ago. I could have taken 8% 3 days ago. I'm just waiting to see what happens. Most likely before the 12th. I'm going to do an income method here. And what I think I'm going to do, probably going to use near-term August 15th expiration, even though the stock is well below my put strike price. It's not too far below, but it's well below my put strike price at 57.50. I'm just going to grab some cheap capital. And what I'm probably going to do is I want to sell the 52.5 call, and I might buy this 57.5. I want to do a bear call spread on this. It's only going to garner me about 20 cents of net credit because I'm going far out of the money. Why? Because that's where my put is. Now, this is going to look ugly for a minute. It's going to look negative. But again, increase the guaranteed profit to 3.7%. The profit is 20 to 30 cents higher than it is right now. Peak profit here, above where my max profit is if the stock moves up to 52. That's a big move. I know that's a big move. 7%. It's not quite 10%. We're talking about a 6, 7, 8% move on the stock to get from 45 to 52. But then I got to watch out for this if it really exceeds expectations. Now, I increased my bulletproof status to the downside. But what if this earnings, the way the stock's been moving, are terrible and the stock drops down to 36 or 38? Okay, so I make $200, where I could get much higher profit, about the same profit right now by liquidating a little bit more. I might take half of that 20-cent profit I just made. I might even go further out in time too. I'm going to take about, no, I'm going to double it, but I'm going to go, yeah, let's go with a 42.50. This isn't going to work out the way that I want. It looked better yesterday, by the way. I think volatility increased. But anyway, here's combining income methods. I did an income method number 6, a bear call credit spread, but in the context of the married put, it left the upside open. I'm going to buy an extra put, and this gives me the W profit and loss chart. This is higher than I could get right now if it's back up to 52. It's a $400 profit compared to where I'm at right now, liquidation value. If it moves down, I'm not quite making that 3%. I'm only at 2.2% if we're at 42.50. But if it collapses, then I'm in this range. Some of the magic you can do with the income methods, there's other income methods I'm going to do on the stocks that have already had earnings that have declined. But why am I talking about this? I haven't even touched Andrea's question yet. If the underlying stock shoots up, when do you suggest to close the underlying to secure the profit?